But let's go ahead and let's get rolling into it. So just for context here, Will, CEO over at GraniteShares. For those who aren't familiar with GraniteShares, they've got a lot of funds that they've created over the years. The most popular one, I believe, is going to be NVDL. So if you haven't seen that one, that has well over a billion in AUM. Wow, oh my gosh, over 2 billion AUM inside of it at this point. That is a 2x long Nvidia daily ETF. Will, that's crazy. I feel like I tweeted about this a week ago and it had 1.4 billion AUM.
Yep, that's probably true. And good morning, everybody. Nice to talk to you all this morning. But yeah, that's sort of been the way that Nvidia's gone these last 12 months. On some days the stock itself is adding, $60 billion, which is, the market cap of, a major US corporation on a daily basis. And so, when you're two times that, providing the leverage to it, you're participating in the growth of the stock price, as well as obviously investors putting money in. So credible story.
Yeah, 100%. And that's surrounded by a bunch of other very popular ones. BAR, another popular one for people as well, especially with, gold being at all-time highs pretty much and just throughout. So I'd love to give you the opportunity here, just jumping in to share a little bit of background on yourself and how you got started in this ETF world and the creation of ETFs and what that looks like on a day-to-day basis.
Sure, no, happy to. So just a little bit about GraniteShares quickly. So we are a ETF issuer. So that means that the only thing we do is we create ETFs. We manage those ETFs, we list them on a stock exchange, and ultimately market them to investors. So we don't have any other business lines like mutual funds or anything else. It's purely ETFs, and we do that here in the US, where we have a platform of around 18 ETFs, and then in Europe as well, where we're listed products on all the major European stock exchanges from the UK to Italy. So the company has, over 4 billion in assets under management. And one of the things that we kind of very well known for is leveraged single stock ETF. So that was a new category. We pioneered that category actually in Europe a few years ago, and then finally brought it to the US about a year and a half ago. So we have a portfolio of leveraged single stocks. Sometimes they're 2x leveraged and 2x leveraged short. Not in all cases, but we certainly have a big portfolio of 2x long ETFs. And actually, this morning, kind of just by complete coincidence that we're doing this morning, we've launched three additional 2x long ETFs. So ETFs on AMD. So that's the first 2x long AMD ETF. Similarly with Amazon, 2x long Amazon. That's the first Amazon one in the market, and then Microsoft. So 2x long. So really, take the success that we've had with Nvidia and NVDL, and kind of do some more stocks related to the AI theme, but particularly with AMD, etc.
Appreciate the high level overview there. So, what was the actual impetus behind starting this firm and creating a lot of leveraged ETFs, specifically within, like you were saying, small cap space, but also on large cap tech?
So I've been doing this for my whole career. So I got started in 2000. I was just out of college, investment banking graduate with the Japanese investment bank Nomura. And I did that for kind of a year and a half or so, and then ended up moving or switching jobs to Barclays Global Investors, as it was known at the time. Everyone will know it now as BlackRock. But I just ended up being at the right place, right time, really, when we at Barclays Global Investors were launching the first ETFs in Europe, and that was the dawn of the 2000s. And at that time, the ETF industry was clearly a lot smaller than it is today, both in terms of AUM, in terms of number of products, and really we were the only company doing it at the time. And so I just saw, because I was kind of on the front lines and involved, very, very early in it, saw the attraction that it had with customers and how, when we talked about other funds or other products that we had to offer, that customers didn't really care about that, and they kept saying, "Yeah, but what about these ETF things? That's like really interesting." And so I ended up really just following that product. So once I left BlackRock, I joined a startup that was launching the first ever commodity funds. And that's why, as you pointed out, Gav, we've got a very large gold ETF in our portfolio of ETFs, but also some commodity stuff because I've spent a lot of time in the commodity markets. And after building and managing products or ETFs kind of in the space, I started GraniteShares in 2016. I was the CEO at the GLD ETF, which is the largest gold fund in the world and is a partnership between State Street and World Gold Council. And I left really because I think, like a lot of people that have built and managed businesses really in any industry, I just saw an opportunity to create a better product at a better price. And I think the ETF industry, in many ways, is kind of analogous with most product building companies, whether you're building products in technology vertical or elsewhere. It's about providing that innovation, providing access to something that solves a problem or provides a solution for people. And so that's what we try to do. And I've been fortunate to spend my entire career involved on the ETF side, been involved in a lot of different products, and specifically, I think that when it comes to leverage, we were doing leverage products in a previous company. At that time, we're providing leverage to commodities, and so providing leveraged oil products, leveraged natural gas, and they were hugely popular with investors. And at the time, just the sort of the technology didn't really exist to enhance or provide exposure to single companies. And really that was something that we'd always wanted to do, and got the opportunity to do that starting GraniteShares in 2016.
That's great. So it sounds like there is that real attraction. How much of the people that are interested in buying these ETFs do you think are institutional versus retail, and what drives the interest within each side?
It's difficult to say. It's like one of the most frustrating things about my job is when you're running an ETF firm, that some people might not necessarily appreciate that an ETF company doesn't really have customers. And what I mean by that is when we issue an ETF, we launch it or we list it on a stock exchange. So, like this morning, we've listed 3 new ETFs on the NASDAQ. That's the AMD, Amazon, and Microsoft, all 2X. And the only way you buy those is you have to go through a broker. So you can't buy them directly from us. So you use your broker of choice to buy those particular ETF shares. And therefore, we sort of disintermediate ourselves from the customer via the stock exchange or via the broker. So sometimes, the feedback that we have is largely through investors that contact us directly, either through the website, social media, etc., or it's looking at some of the public SEC filings. There's a form called the 13F form, which institutional investors have to file on a quarterly basis. That shows their holdings in any given stock or any given security, including an ETF. So there we can get a bit, just one day and time of who's holding it. And with any big successful ETF, I think there's always a mix. So you'll get anything from what we assume is retail investors through the likes of shareholdings from your Schwabs, your Fidelities, your Robinhoods, and things of the world, up to your most sophisticated hedge funds and algorithmic trading firms. So there's a real sort of slew. But I think the other thing, which maybe is worth talking about for a second, is also that when you get a product that is like NVDL or some of the others, it's also a global appeal. And so you'll get investors trading that from other countries as well. And, that sort of becomes a global appeal because there's only one, like it. So we get all sorts of investors in all shapes and sizes from all around the world in some of these products.
Yeah, I really like that. It seems like there's a place for this in a variety of portfolios. So I guess I'd flip that back as the question. When it comes to leverage products, me and you had a brief conversation about it. People talk about the K, other items like that. Where do you see these products fitting into? Let's talk about the retail investor's portfolio.
So first and foremost, I mean, these are active trading products, which means that when you're taking two times leverage to anything, then the risk is amplified. Obviously the opportunity for return is also amplified. But fundamentally, these are for active investors, we say, who can monitor or do monitor their portfolios on a daily basis. So whether you're long or short, the short ones are kind of interesting because most of the long applications are fairly intuitive to people in terms you buy and hope that the underlying stock goes up, or therefore the leveraged ETF goes up, and you can do that to put if you're following technical analysis, and there's a particular pattern you're looking at over a day or a few days, a week, etc., or it's earnings. There's a big piece of corporate news that's coming out. You can play all that, but also on the short side, that where you have access to something like the 2x short product, includes an opportunity to go short that for the majority of investors, and certainly retail investors, that's super difficult to do in a portfolio, and it's actually makes that process a lot more efficient than through doing it through traditional margin accounts. So really, think of these as disrupting your kind of traditional margin account of brokers and providing access to leverage that's a lot more efficient, meaning cost efficient, and easier to use. And ultimately, you, the investor, are in control as opposed to the broker being in control with a traditional margin account.
That's great. I want to work around the panel a little bit, get some others to have a chance to put some thoughts in here. I did put up a tweet if people want to go ahead and check that out, just tagging some of the tickers that are kind of most on my radar, but there are a bunch. I do recommend you just pop right to GraniteShares, and you'll be able to see it on their website as well. You can go through Will's bio for that too. But let me bring it over to Evan, see if you have some thoughts or questions here at the top, and then we can circle around with Shy and others.
Yeah, no, I definitely appreciate you coming on here and joining us. And I know these are a really big flavor of the market that are going on. So I appreciate you answering the questions. You kind of answered a couple of the ones that I had coming into this, but like I was going to ask who, when you were making these ETFs, who were you really kind of having in mind? And it sounds like that more kind of experienced trader. The comment there around a margin account, I did find to be pretty fascinating. Like when you were thinking about making these, what was like the biggest detractor in your opinion for a margin account that you think these ETFs solve?
I think it's not just one thing. It's like a lot of financial processes that have been around for decades that they haven't been innovated in any way. They're typically very clunky. If you look at the interest rate you pay in terms of borrowing money from margin account, you can see it. Most of it is public in terms of large brokers, but we're talking in some cases upwards of 12% plus, per annum, and that's just for the margin loan. That's not the amount of margin that the broker requires, and then all the paperwork that you have to fill out to do that, and the amount of collateral that you have to have, in terms of net worth, etc., for that position. So there's a number of things that just make that very inefficient. And I think that kind of goes to the popularity of leveraged ETFs more broadly, not just leveraged single stocks that we have, but leveraged ETFs have been around now for well over a decade, and it's super popular. Many of you probably trade products like the T Triple Q, etc., which are very, very popular. And these are all just making it much easier for people to do it. And I think probably ultimately and most importantly, that when we talk about leverage, we're also talking about risk, and the maximum risk of loss with a leveraged ETF is the amount that you invest in it, have invested in it. And that's important because although hopefully the chances of that ever happening are incredibly low. So for example, with a leveraged single stock, you're two times levered, Nvidia would have to drop by 50% or more in a day. So hopefully the chances of that, while maybe they're not absolute zero, but it's certainly pretty close, that with traditional forms of leverage, that's not necessarily the case. In other words, you could end up losing more money than you invested, end up owing the broker money, And particularly that's the case if you're short, where potentially you can be exposed to unlimited losses. So really important to understand that yes, you're using leverage, but the ETF wrapper, like the ETF wrapper does with other types of investments, makes that more efficient, but also safer, because when you're using leverage, your maximum risk of loss is the amount that you have invested in the fund.
Gotcha. That makes sense. You kind of talked on how like these leveraged ETFs have been around for a long time, and we're kind of getting into a new flavor with these individual stock ETFs being leveraged. So I kind of would love to just hear what, in your opinion, makes GraniteShares different from other ETF providers, and kind of your strengths and why people should be kind of watching your all the stuff that you come out and launch. What makes GraniteShares different from other ETF providers?
I think it's sometimes perhaps maybe difficult, or not so much, or not obvious, I guess, if you're looking at the ETF space as a whole. But certainly what we try and do is there's a big sort of gap between the top firms by AUM, so the BlackRocks, the State Streets, the Vanguards, and they all offer kind of a very similar recipe. In other words, they offer typically generic portfolios, so things like the S&P 500, but major benchmarks, whether they be in the equity space or the fixed income space. And these sort of generic benchmarks they offer at scale for very low cost. And typically that's the offering, whether you're talking about going to Vanguard or whether you're talking about going to BlackRock, etc. They're all very similar. So a firm like GraniteShares can't compete directly with a firm like that just on the basis of these generic benchmarks and on cost alone. The reason for that is that our business, unfortunately, works almost in a sort of inverse way to perhaps the way that people think intuitively about any kind of small business. So normally, a small business or a startup has an advantage over an incumbent because you can do things for cheaper. Whereas in the financial world, unfortunately, that's upside down, whereby the smaller firm has a disadvantage because we don't have the pricing power or the economies of scale that big firms do. So you have to kind of get over that particular gap. And therefore, what that lends you to do is you have to offer products that are unique. You have to offer products that are different and provide a solution for people. So we've always tried to do that, with the portfolios that we have, whether it was gold, we launched our gold ETF. And when we launched that gold ETF, that was the lowest cost way to get access to physical gold in a portfolio. And the same with a broad commodity fund. We have a platinum ETF as well, and all those try and compete on that proposition of offering good value for that particular ETF and differentiated by the fact there's not many others doing it. And then outside of that, whether it's we have an income ETF where there's lots of income ETFs out there, but again we try and be unique and offer one that pays what's called a fixed cash distribution. So you end up getting 10% plus per annum, but that's paid out on a monthly basis, and it's a fixed cash distribution, and that's HIPS. And then we have a disruptive tech ETF where we're trying to capture disruption as a factor, and that is in partnership with NASDAQ. The ticker is DRUP or DRUP. And again, that's a completely unique strategy. And then the single stocks we kind of talked about, but we really pioneered that whole concept because there were leverage in the leveraged ETF category. There were leveraged ETFs on broad equity indices. There were leveraged ETFs on broad fixed income indices. We at a previous shop were doing leveraged ETFs on some commodities, both broad indices and individual commodities, but nobody had yet figured out how to do leverage on individual stocks. And so we figured out how to do that, did that for the last few years, and then figured out a way to bring that to the US. And so that's now an area of the market where we've had a lot of success in, because typically, like any new product, if you're first to market or if you're a pioneer in something, and that's a successful category, and there's a lot of interest in it, then that becomes really sort of good business line for you. So hopefully, we have a diverse range of products in the company, but we try and differentiate ourselves as offering things that are unique, offering things that you just won't get from a large ETF shop, the likes of the BlackRocks, etc.
It definitely makes sense. I appreciate it. I got one more question, then I'll throw it back to Wolf to keep us moving. But um, maybe we have to get technical here. Maybe we don't have to get too technical. But I would love to hear kind of a little bit about how these leverage products actually physically work on the back end. What type of markets are we using? Swaps? Are we using some other stuff that I'm not aware of? How do they actually kind of work on the back end to get this additional leverage?
Yeah, that's a good question. So, the way that they work is they use swap contracts, which are a type of derivative which we get from an investment bank or a large broker dealer. And so that's how the fund obtains leverage. So when an investor, invests in that particular portfolio, these are fully paid. So the fund receives $100, for that particular creation, and then we use that money to obtain the leverage via a swap from an investment bank. So there's a margin that's applied to that, but ultimately the funding that we're getting from that position is in the form of a derivative contract. And then we rebalance that position at the end of each day. And the reason that we're doing that is because the sort of stated investment objective is we're targeting, if it's two times leverage, we're targeting two times leverage. And so that mathematically, the way that you do that is by having that leverage set at the end of each day. And therefore, for the next day, once you're rebalanced, you achieve the two times.
I lied. One more question. Do you have any data on like how long people are holding these ETFs? I don't even know if that's something that's possible, but like, is the
Yeah.
average? Is it possible?
Well, it kind of goes back to the short answer is no, but it goes
Gotcha.
back to the question you asked about, who's using them. And related to that, we don't have customers officially. So therefore, we don't know how long people hold, whether people are holding for their entire lifetime. I hope they're not, or they're holding for a day. We just don't know. What we know and what we can tell is we look at the trading volume, obviously, which everybody can look at. That's public. And then what we receive at the end of each day is we receive the net of the buys and sells in the market, which market makers give to us in the form of what we call creation units or redemption units. That means that that is a certain amount of orders that we get from the fund to either increase or create more shares or cancel shares if people are selling. So we see the net of all of that, and then we see obviously the turnover in the form of the trading volume, but we never see we never see to the underlying individual shareholder level.
Gotcha. Yeah, that makes sense. I'm actually taking a look into the trading volume right now. Last couple of weeks have been pretty good for you. It looks like March 11th was the no, actually March 8th might have been the peak of the fund so far at 49 million shares about. Interesting. Today we're already at 12 according to Yahoo Finance data.
Yeah, yeah. Today I'm sure will be quite a big day, but yeah, it just depends on what's going on. Obviously, sometimes you can have even a bigger volume day for perhaps maybe obvious reasons when the market's down rather than when the market's up. You just never know.
Yep, I appreciate you answering the questions. I always got a couple more in the locker, but I'll throw it back to you, Wolf, and we can go around.
Yeah, I want to get it over to Shy here. Definitely curious to hear his thoughts.
Yeah, I appreciate that, Gav. So I'm looking at your website, the ETFs. You kind of have all the big players of the ones who are heavily traded in the market every single day. What's your process of kind of finding these leveraged single stocks? Like, do you do it based on volume in the market every single day, or is it based on certain thematics? Like, you want exposure via crypto, semiconductors, and
Yeah.
EVs. So that's why you have Tesla, Coinbase, and Nvidia. Is it more like thematic type of ETFs that you want to leverage for single stocks?
It's kind of a combination of two things. So one, we're lucky because we have a test bed, if you want to look at it that way, of products that we've launched in other markets outside of the US. So we have a good idea of what's popular and what's not. So from our last few years trading history on London Stock Exchange or in Italy and France, etc., we know typically what people like, but clearly there's regional variation. So our biggest product in the UK is not Nvidia, it's Rolls-Royce. So, again, that's probably something that no one would expect, but there's always local variation, or it can be local variation as opposed to just the mega US stocks that everybody tends to focus on. But it's a bit of it's a combination of more of an art than anything else, and we try and clearly identify stocks that people love, and people want to trade. So those there ideally will be large, cap stocks with a lot of trading volume, and that obviously makes it easier for us to offer a product on them. But I think to your point, it also helps if they're solving a problem for investors. So, when we launched our CONL is the ticker, but it's 2 times Coinbase. That when we launched that, there was no leveraged ETF on crypto. So you had at that time, which again, market moves very quickly. This was only about a year and a half ago. You didn't have spot Bitcoin ETFs. You only had an ETF that was tracking futures contracts on Bitcoin. So something like Cornell was a way to offer people leverage on crypto through the ETF wrapper that didn't have direct exposure to the underlying. Similarly, with something like Alibaba, where we have BABX, that BABX is the ticker. Again, that's a leverage play not just on Alibaba, Chinese tech, but on China, more broadly. But doing it from a US listing, so you don't have to have an underlying Chinese listing, etc. So there are lots of ways we look at it in terms of trying to bring products. And for example, today, bring in AMD, AMDL, which is the 2x AMD. Part of that is because we had a huge amount of requests for AMD, given the success of Nvidia, NVDL. So, we do get customer feedback from people coming to us and say, hey, you've got Nvidia. I also think AMD's a good one. Can you add AMD? And obviously, if there's a case for that, we'll add it. Similarly with Amazon and Microsoft, that they're, just stocks that are super popular with people, but there was no 2x version of those, a 2x expression of those in the market. And so bringing them out. So it's always going to a combination of different factors. There's not so an absolute science to it. But I probably should say one other important factor more than anything else is the size is important because when we're financing these via swap or via derivative contract, it's super important for the stock to be at a level where a continuous financing is possible. So there are going to be some stocks in the market that people might want to get exposure to. And I'll just give an obvious example because it's something that clearly we've been asked about many times before, and there's a reason why we don't have it. But when you look at some of the meme stocks, like the GameStops, the AMCs of the world, like we can't provide that in 2x leverage form because, or if we could, it would have to be very capacity constrained, which doesn't work for an ETF. So people might be able to finance, $20 million worth, $30 million worth of exposure, but not more than that because it's just too volatile. So again, a lot of the companies that we offer are gonna skew large, and that's because we have to be able to consistently offer a product that does what it says in the tin, which is try and target 2 times leverage on a daily basis.
God, I appreciate that, Will. So for that specificity of like the market cap, like would you say like SMCI is super volatile, but now that they've gone to the size they're at and they're getting the S&P 500, would that potentially those factors change, maybe creating a 2 times leverage single stock for
Yeah.
them? Or yeah, it would.
Yeah, it would, but I think the problem with SMCI, well, I'll tell you, I know the problem already with SMCI, just the volatility is too high, meaning that again, we would have difficulty probably, getting partners to finance that on a consistent basis. So there'll be people that it's similar to the analogy I used before, probably say, okay, we can provide, $50 million of capacity, $100 million of capacity, whatever it may be, but probably the volatility is the one big constraint, and that means for us, the margin So clearly we have to have, a margin that's below 50%, or the 2 times leverage doesn't work. So that's the challenge with a lot of these companies, that even though they might be of the size where it gets more interesting, it's more the volatility of the actual name.
Interesting. That makes sense to me. So for the short ones, is it like I see there's no short one for Coinbase, Microsoft, or Meta? Is that due to
Yeah.
lack of demand requesting it, or is it because of some the volatility is too great on the downside?
Kind of a combination of both, and not combination of both, but in every case. But for example, certainly on Coinbase, providing a short, the volatility is just too high. And the other thing we're doing, again, which is an amazing sort of bonus, if you will, or amazing sort of product benefit, is it's an instant locate when you think about providing short access to any stock. So when you go and short a stock via traditional means, you have to locate or source that stock for a borrow. And that's sometimes easier said than done, and particularly with names such as Coinbase or in the crypto names, that can get a lot more difficult to do that. And typically, when you do that via a broker, there's strings attached, like the loan has to be for a certain amount of time, and if you break the loan before, there's a penalty, etc. And when you buy the ETF, you don't have any of that. You just buy the ETF. You're in control. You buy it and sell it whenever you want. So clearly, again, that leans itself more to stocks where we have the certainty of being able to provide that. So in the case of Coinbase right now, we can't. Maybe that market develops to a point where we can, but we can't at the moment. And with some of the other stocks, it's more just that the market skews long. So with Meta, for example, I'm sure we could provide a short on Meta. I think the reason we haven't is just because the market naturally skews long for these products. And typically, where we see there being a short is where we have like big interest in the long. Tesla at the moment is a bit of an exception because the stock price is down. And so therefore, I would say that some of the action that we normally see around Tesla has migrated, I think, to the likes of Nvidia. But Tesla's a stock that consistently, whether it was in Europe or here, was right at the top in terms of the most interest. So TSLR is our 2x long Tesla, and then TSDD is the 2x short. And so those particular products would see a lot of interest in both on the long and the short side. And then Nvidia is the same. So NVDL, huge amount of interest on the long, but also because these stocks have a lot of interest on the long, you also get a lot of interest on the short as well. So that's NVD is the 2x short.
No, that absolutely makes sense. I do think these ETFs are like perfect vehicles for cyclical industries like EV and semiconductors. So clearly, you're seeing the AUM on like the bullish side of the cyclical via Nvidia and probably soon AMD, and you're
Yeah.
seeing like the lighter side on Tesla. Last question I have is it's not cyclical, but it's in a way highly vulnerable to interest rates. Is small cap. Do you anticipate anything in the pipeline in the future, like adding a long IWM 2x or like maybe a short IWM 2x, just playing off what the Fed's going to do on interest rates this year? Or if not, is there anything else in the pipeline that you guys are dipping your toes in potentially of including into the ETF holdings?
Yeah, that's really interesting. I think we've all been sort of thinking about, or certainly I say, speak for myself, wondering if this year was going to be the year that we'd see a rally in small cap. And we haven't seen it so far in terms of the same magnitude we've seen clearly in the Nasdaq and the S&P, but certainly could very much happen if interest rates do start to fall in the back half of this year. So at the moment, we don't have any plans to bring out anything there, but I only say that because when I'm talking about at the moment, I'm talking about the registration statement where we have funds that are already effective. It's sort of another way of saying they're already approved, but they're kind of on the shelf and haven't been brought to market yet. So like the 3 that we just bought today are off of our existing shelf that we'll bring to market. So we still have some products we'd like to do there. But definitely, we're always focused. I mean, we're a product first company, so we're always focused on what new products can we launch. We like the income space. I think there's a lot more to do there, particularly in the option income space. But definitely, expanding the leverage, not just to leverage on single companies, but onto baskets, indices as well. Definitely something that we're interested in doing.
Appreciate it. Thank you for answering all my questions. Well, hopefully I didn't exhaust you with all them.
No, not at all. Thank you.
Great questions there, Shai. Yeah, and I like that I'm continuously learning more as well here. This is, of course, the first space that we're dealing with. You are going to have you on a few more. I want to bring it over to Nate, who's up here on stage, more of an active trader, and get your thoughts, Nate, on some of these tools, double leverage ETFs, and any questions that you have here.
Yeah, you guys have asked a lot of the questions I had, so I think I'll reiterate some of the things that I really like about this. And thanks for taking the time to talk about these single stock ETFs, because I think there's a lot of questions out there and curiosity. And really for me, what I like about it is it kind of helps you simplify day trading. If you're looking to get into options, it's because you want to get that leverage, and there's a lot of learning. There's a learning curve, right? But if you're used to trading common shares and you want to just get a little bit extra leverage, a little bit added beta there, extra return, I mean, these are the vehicles for it. And I just really like that the conversation has been around what these ETFs are for, which is short-term trading, right? They're not buy and hold long-term vehicles necessarily, right? Because of the leverage involved. So if getting wise and on how to use these types of products, and like I said, anytime you can simplify your trading, I'm all for it, because it takes a little bit less thought out of the process, and it lets you focus a little bit more, at least for me, on technicals. Is how I like to trade. So yeah, I really appreciate these coming forward. I guess the only question you kind of hit on it, I think, but you mentioned that you need to have a certain amount of liquidity, and too much volatility can be a bad thing. When we're talking about SMCI, for example, as far as if you have a stock that just becomes too volatile to continue, is it just one of those things where you would have to effectively shut down the ETF, maybe pause it temporarily, or how do you go about managing that when a stock just all of a sudden becomes one of those that is trading huge spreads every day?
That's actually a
You got
great
a call.
question.
Sorry.
Yeah, no problem. I think that the way we probably have a few levers to pull on that. So the first one is I guess it's obvious maybe to me, but not to you guys listening, perhaps, unless you're kind of really into these funds. So the way that these funds work is that we target 2x leverage, which means that it's an active strategy. So it's not guaranteed that we get 2x leverage. Now it's all transparent, so you can see, on the website in terms of the holdings that we're achieving that investment objective. However, if it was like super volatile and we were no longer able to do that, then I think one solution would be that we'd not be able to achieve the full 2x leverage, and the fund would be under levered to that particular stock. So might end up being 1.7 times or 1.8 times. But I think we'd have to probably take a view on how long that sort of period would persist, because clearly you wouldn't want to have that for certainly in an indefinite sort of position. And so I think if it became clear that the volatility just had stepped up almost to a different sort of plateau, and that was something that was likely to endure for the next few years, I think what we'd probably do is investigate bringing down the leverage as a permanent thing. So rather than saying, okay, we'll try to hit 2 times but not hit 2 times, bring it down to something that's manageable, like say 1.5 times, where we'd meet the investment objective and give people 1.5, but knowing that we're now at a different volatility threshold where it's just not practical to say we do 2 times. So fortunately that hasn't happened, but there are a few options that we could do to try and sort of get around that.
Appreciate
Good
the answer
stuff.
there. Yeah, Nate.
No, I was going to say, appreciate the answer there, and that's good stuff. So thanks again for all the details here. I'm definitely looking forward to learn more about this stuff. That's all I had for now. Well, thanks.
Yeah, and on the closing, that's sometimes a good find. So we would only ever close an ETF if the asset, like, it's not commercially viable. So it'd be difficult to envision a scenario where we would close it a commercially viable ETF. So that typically will always be, we're closing because it's just not profitable, and that's the small amount of AUM. Maybe the sector's gone out of favor, or the stock's gone out of favor, or something. But that will be a function 9 times out of 10 of it not being commercially viable.
Good points. Hey, I liked how we discussed the expense ratio and how you broke that down, especially for people that
Yeah.
are trading a product like this. Are you able to walk through that? I like that you broke it down for me.
Yeah, no, absolutely. So again, the expense ratio is purely a regulatory concept, meaning that we disclose or have to disclose all the fees, irrespective of whether you, the investor, pay those fees or not. So if you look at the fees for the leveraged ETFs, for example, you'll see that we charge 99 basis points as a company. And then there is typically an extra 15 basis points, and those are to cover the trading expenses of the fund. So you, the investor, pay the 99 basis points. And I think it was a really important thing to think about here, that a lot of times when people look at the expense ratio, remember that people are trading these products on a shorter term basis. So the reality is you're holding this product for 1 day, 5 days, 10 days, or whatever. So the amount you're actually paying is 1/365th of 99 basis points, so like a fraction of a basis point every day to hold this. And if you're trading even intraday, it's technically free other than the bid offer spread, because you don't actually pay, management fee only accrues over 1 day. So the cost and the reason why these are quote unquote higher than your traditional ETFs is also a function of, one, the product clearly is more complicated than your kind of standard ETF that you'll see from the likes of Vanguard. But two, the scalability is not there. So it's just a different market. So when we size it from a commercial perspective, we're looking at a product that, yeah, it's nichier. So therefore, it's not going to be hundreds of billions of dollars that are sitting in a S&P 500 ETF. It's a more limited market, and therefore we have to price that appropriately. But the moral of the story is, when you're looking at these, typically for the holding period that people are using, the cost is exceptionally cheap, especially when you're comparing it to traditional forms of leverage that you're using at traditional broker, etc.
Got it. That's a good breakdown. Yeah, I think people get a little bit confused sometimes with the fee structures. So it's helpful to just have it clearly explained so that there's no real confusion here. What do you think are some of the trends of the ETF world over the next few years that you see people gravitating towards? And if that is the leverage side, what are some of the possibilities there? What's the interest? How do you think that continues to fit into portfolios? Is it the medium trading tool? Just kind of your vision here for this industry and where it's going.
Yeah, I think there are three big things that are going on in the industry in terms of trend. The first one, perhaps more obvious, is the trend in fixed income. There's been a huge explosion in fixed income products. And as most people will probably think is kind of intuitive, that's because for the first time in decades, we have, positive real yields and a market where, interest rates are 5%. So you can make 5% on a money market fund. You can make 5% on a treasury fund. You can make 5%, plus a corporate bond fund. So that's very appealing to people that are looking for income. And it's had a big sort of explosion in terms of demand and product creations of opportunities in the fixed income space. The other one is sort of related to that, is anything to do with option-based income. And typically the appeal there is that depending on what strategy you're talking about, by using options, and using options, whether it's call writing strategies, etc., you can sometimes generate a higher yield than the respective underlying asset class, if it is even a dividend paying or it's fixed income, etc. So there's been a big growth in options based income products. And then the last one is not just leverage, but I would say more, let's call it esoteric type payoff products. So leverage is definitely one of those. But again, when you're talking about a bull market type environment like now, anything that gives people amplified exposure to the various either most popular stocks or most popular themes or sectors is going to be very popular.
Paul, jump in.
Hey, Will. Thanks for being on here. Wolf, everyone else. A lot of great questions, a lot of good comments. A lot of my questions got eaten up, but it's okay. It's a team effort here. Will, you had mentioned, so I'm not very familiar with leveraged ETFs. I'm sure a lot of people listening aren't. Also, I mean, there's probably a mixed bag, but I'm sure there's some out there like me that have never traded it, haven't looked into them too deeply. So I do trade options daily. I am a long-term investor. You had said, I hope that if someone's holding this, they're not holding it for life. Can you just kind of break that down? Like, why would it be such a bad idea to hold on to this, for more than 5 days or 1 day or whatever else?
Yeah, that's a great question. So let's talk about that. When you're trading these particular products, the biggest thing to understand is that the return payoff is not the same as a linear return. So these are non-linear, or what's called path dependent, and that differs. And let's use an example so that people can hopefully visualize what I'm talking about. So if you assume a 5-day week and you start on day one, and let's say you're leveraged in a traditional way 2x to a stock like Tesla. So if you were to borrow money, from your brokerage account, in a margin account, etc., to take a 2x Tesla position, then you would hold that, and let's say by Friday, whatever the price of Tesla was, you would have 2x that in your account, so on a notional position, and you could sell it. Now, that's what a linear return looks like, where people think, okay, whatever the stock price is over a period of time, multiply that by 2, and that's my return. That's not the return that you'll get with a leveraged ETF. That is a non-linear return. And the reason for that is because we rebalance the portfolio at the end of each day. And the reason we do that is because that's the only way that you get 2 times leverage. So for example, if we said instead of rebalancing it every day, we'll rebalance once a month. Well, for the first day, that product would be 2 times leverage. But if you bought in on day 5 or day 10 or day 15, there would no longer be that 2 times leverage. You'd be detached from that. You might get even a little bit more than 2 times, you might get less. But the point is, it's not exactly 2 times. And so the only way you achieve that is by doing that daily. And so what does that mean? Well, it means that there's 3, broadly speaking, return environments that people should be aware of. So the first environment is what we've seen with something like NVDL, which is a stock that, let's just, for simplicity's sake, has gone up, over the past year and a half, certainly since we've launched the product, and is a stock that is more often than not going up every day. And in that environment, what the leveraged ETF is doing is at the end of each day, it rebalances. So it's not just taking 2x leverage on the price of Nvidia, but the profits that are generated as well. So reinvest those profits and then take 2x leverage on those profits. So what you get is a compounding effect, just like you have, with any kind of compounding of money. And so in that environment, you'll almost certainly have a scenario where the price or the return of the leveraged ETF is more than the 2x or the linear return on the underlying stock over that period of time because you're compounding those gains over time. Now, obviously, the inverse is also true. So if we were talking about a scenario where the stock was just a terrible, terrible stock and was losing value every day and you were 2x leveraged on the long to that stock, you'd also be compounding those losses on a daily basis. So you would underperform, the 2x version of that on a linear return. And so that's all relatively intuitive to people because, stock goes up, they want to see a 2x leveraged fund go up. And obviously, if it outperforms in the sense of returning more than the 2x of the underlying stock, so the better. And obviously, if you lose money, people also expect that if you're 2x leveraged and stock's going down, then you're going to lose more. It's the scenario in the middle that causes the most confusion, and this is the one that really people have to understand. And that is where you have a choppy market or a market where it's not directionally defined other than you might get a few days or a day where the market goes up, next day down, up, down, up, down, up, down. In that particular market, the 2x leveraged long ETF will lose money in that environment because you're compounding, again, on the upside, reinvesting. Those compounded gains will then turn into losses the next day. And then obviously when you have the loss, you have to generate 2 times to get back to flat. So that environment is the worst kind of environment. And so that is hopefully a market that, people wouldn't want to sort of trade longer term anyway. But that's why when I say things like, I hope people don't, buy and hold forever, is unless you're looking at the markets every day and looking at your portfolio, you obviously have these periods where the stock will be directionless, or even worse, will have volatility to the up and the downside on a very frequent basis. And that's not a good environment for these products. So you want to be in trending markets, momentum-driven markets, to the upside, obviously, if you're long, and on the short side, if you're short, the downside if you're short. That's really the best environment. But what
Makes
you
a
don't
lot of
want
sense.
is periods. Yeah, so it's just we can't. None of us can predict the future, so we can't say like, okay, in 5 years from now,
Sure.
Nvidia might be doing that, going up and down, up and down, up and down, and it's not a good market for investors.
Makes a lot of sense. Thank you, Will. And so are you worried about just massive amount of outflows during those choppy markets? And are there any other sort of existential threats to this type of product, like maybe regulatory, maybe like you said, the product becomes unprofitable, maybe that those swap contracts become just too expensive, too unfeasible. You can't get the leverage that you need. Are there any other sort of existential threats to the product?
The biggest threat is just, and again, it's just the investment objective itself. So the biggest threat is that the price of these stocks drop 50% or more in one given day. All right. So if you're 2 times leverage, then that becomes 100% loss plus. So the fund goes to zero. So that's clearly the biggest risk of any leveraged ETF or leveraged investing more broadly, because that creates a complete wipeout, of our fund investors' returns. I think
is that even possible? Aren't there circuit breakers that would make that impossible, or am I mistaken?
Yeah, no. Well, this is where we get into some very, very technical stuff. So you're 100% right. During the day, again, I'm not going to say it's impossible because there may be one scenario, a kind of black swan scenario I'm not thinking of, where even with circuit breakers and everything else happen. The bit you got to be a bit careful of is there's actually the gap risk overnight. So it's more likely to happen overnight. In other words, when the market's closed. So let's take let's just be stupid for a second. But let's say, for argument's sake, that the CEO of Nvidia came out middle of the night and said, "I'm sorry, everybody. It was a complete fraud." The stock would gap down and no one would be able to get out. So by the time the market opens, it's over. It's already down 50. You know what I mean? So that's these like very, very weird.
That makes a lot of sense. Yeah. Some
Yeah.
just crazy news story, yeah.
Exactly.
And it
Or
could turn out to
Bitcoin.
be that the news story was bogus, but you're already sort of behind the eight ball. Yeah,
Exactly.
very interesting.
Yeah. So that's when, like, from a pure like trading perspective and a fund management perspective, you have to think of all these like very edge cases that hopefully will never happen. But those are scenarios that have to be factored in, especially when you're providing leverage, and counterparties are financing it.
Awesome. Thank you. Really appreciate it.
Yeah, no problem.
Beautiful. Got just a few minutes left here, Kim. Not sure if you had any questions or thoughts you wanted to throw into the mix before we wrap up a little bit here, but I figured I'd bring the mic over to you just in case. So, any thoughts here?
No, I really appreciate the discussion and everyone's asked great questions. So just thank you for explaining your product and for having me a part of the panel.
Beautiful. Appreciate it, Kim. Will, just kind of as follow up from this, I know we're doing another one later this week, but for the audience, what do you think are some good ways people can start to do due diligence into these, research, get a good understanding if these are the type of products that are going to interest them?
I think the first thing is what I would recommend, with any kind of financial product. It sounds so boring, but these are the things that matter. Is really understand what you're investing in. So, on our website, we have a lot of information that people can look at, whether it's anything with the fact sheet, which is kind of fairly high level, to the prospectus, and looking at those risk factors, in the prospectus. We also have a good FAQ section, which goes through probably, I would say, 99% of the most frequently asked questions that we get. A lot of what we've talked about here, but the reason why we've talked about it is because these are all, the most relevant questions that people have. And so people can look at that. And then also come to us with any questions. But leveraged ETFs, like I said, have been around for a long time. There's a lot of good literature just online, just generally speaking, about how these products work. They all work in a very similar way. So whether you're buying the TQQQ, which is giving you exposure to a broader index like the Nasdaq, or whether you're buying, our AMDL, which is 2x AMD, they all work in a very similar way. So the daily rebalance, and that really, if you kind of take away one thing from all of this, it's to understand, how that daily rebalance works, and just to think about, the trading environment that you're in, and how to sort of most appropriately apply that.
Perfect. Appreciate it, Will. Really, really nice rundown. To the audience, if you want, you can go directly into Will's profile to check out graniteshares.com there. Big thank you to him for coming on. Like I mentioned, he'll be back on later this week as well for another chat. ETFs are, I think, a staple of a majority of investors' portfolios. And these ETFs bring some new opportunities to the table. Of course, there are the leveraged one. There's also ones like BAR, which is just a straight up gold trust. And that one's doing really well this year. I believe it's trading, like I said, up near all-time highs. There's been a lot of interest, clearly, from the market, from both institutional investors as well as retail investors. So, Will, thanks so much for coming on today. Any final comments for us?
Yeah, just thank you so much for having me. It was great fun. Hope it all kind of made sense. But if, like I said, if people want to ask questions, take this offline. Find us through our website, graniteshares.com. You'll see there's a chat function. You can chat to us, send me an email. Just to reach out. We're happy to answer these questions. But yeah, thanks very much for doing this. Super important that we're able to talk about these products and how to do leverage investing with people. And hopefully, with the markets trading the way they are, people have a good experience.
Perfect. Thank you so much, Will. Have a great week. Looking forward to chatting with you on Friday.
Take care. Thank you so much. Bye.
Absolutely. Have a good one.